Welcome back, dear friends. We discussed the basic capital budgeting setup in the previous discussion. From here, we will start forecasting the incremental earnings because we learned there how to calculate the incremental earning. We just calculate the whenever a new project proposal comes in front of us, we have to calculate the incremental revenue the project will provide minus whatever increment cost the project will involve. And once you get the EBIT, once you get the gross profit, if incremental revenue minus incremental cost will give you the gross profit minus the selling general administration expenses minus depreciation will give you the EBIT. From the EBIT, you will just deduct the tax. Then the incremental earnings will come. With the incremental earning, we add back the depreciation back. We deduct the initial investment. We make adjustment with the working capital changes. Then we get the free cash flow. How we do that? Let us see. Before going to the free cash flow directly, there is a question here which you can see for Kellogg's. Kellogg's is very popular company having 460 million yearly profit. It is having the normal profit the company is doing. Now Kellogg is thinking for introducing a new product. The new product will be known as gluten-free breakfast pastries. And if it is introduced in the very first year, the company has to spend a lot of money for advertisement. It will cost 15 million loss for the company in the first year. If it introduce the new product will make 15 million loss in the very first year. Now, the company is paying 40% tax. Its normal profit is 460 million without the product introduction. How much the company is really suffering loss because of the new product, we have to calculate. What we will do, normal operation without the product, we will calculate the tax and we will calculate the tax with the new product and we will see the difference. Let us go for the solution, please. If there is no new product, what Kellogg will pay tax? 460 million, its normal operational profit multiplied by 40% tax is 184 million. That is the tax without any new product. Alright, now if the company introduces the new product, that is gluten-free breakfast pastry, then it will have a 15 million loss, pre-tax loss. Then what will be the new pre-tax profit? 460 normal profit minus 15 the loss from the new product, so 445. If 445 is the pre-tax profit, then what will be the tax? 40% of that, 178 million. So before, without product launch, the tax is 184 million. With the product launch, the tax will be 178 million. Because of the new product launch, tax reduced by 6 million. 184 minus 178 is equal to 6 million. This 6 million will be adjusted with the pre-tax loss of first year of the new product, that is 15 million. 15 million is the expected loss minus 6 million is the tax saving. So the actual loss to the company will be 9 million. Like this, we have to make the adjustment of tax saving because of any new product and its expenditure, how the tax is being reduced. Now we will see the free cash flow. As I told you, once incremental profits are being calculated, how? The incremental revenue minus incremental cost is equal to gross profit minus SGA minus depreciation is equal to incremental earning. With the incremental earning, you add back the depreciation, you deduct any capital expenditure, you adjust with working capital change, then you get the free cash flow. How it happens? Let us see here. There is a simple, for example, company A and company B here. Both are getting incremental gross profit 1 million. But company A is doing correct treatment. company B is doing wrong treatment. How? Company A is having 200,000 depreciation. Company B is also having, but it is not showing. Why? Because it is saying, why I will deduct once 200,000, add back again 200,000. I will not show. But company A, deducting 200,000, EBIT is 800,000, tax 40%, 320,000, incremental earning 480, add back the depreciation 200, incremental free cash flow is 680. But the other company, which is making a wrong treatment, not showing the depreciation of 200,000, because it is saying, why minus 200 again plus 200, I will not show in my books. Then what will happen? The EBIT will be 1 million, tax will be 400,000, incremental earning will be 600, no add back of depreciation because it is not shown in original, not deducted, so no add back. So the incremental free cash flow is 600, which is less than the company A, 80,000 less. Why? Because the tax paid more is 80,000. You see the tax of company A is 320, the tax of company B is 400. Why? Not showing the depreciation. Depreciation is a tax sealed item. If you are showing depreciation, you are saving tax. So company A, we have discussed in previous chapters also, because tax is not shown, the company B paid more 80,000 tax extra. Because of that, its incremental free cash flow, its incremental earning reduced by 80,000. Now let us go to the HomeNet example where incremental earnings we have calculated before, and now what we will do, the depreciation which is deducted now add back. Up to line 9 we have discussed how revenue is 13 million minus cost is 5.5 million, gross profit 7.5 million, SGA 2.8 million, depreciation minus 1.5 million, EBIT is 3.2 million. Income tax is 40% of the EBIT, so 1.280 million from year 1 to year 4. In year 5, the income tax will be plus 600,000. You know, we have discussed in earlier chapters also, always profit and tax are opposite relationship. Whenever there is a positive profit, tax will be negative. Whenever there is a negative profit or loss, negative profit is in Excel sheet, negative means it is a loss. When there is a loss, there will be plus in the income tax. That means that tax credit will be adjusted in future tax payment. The 600,000 here the company got as a tax credit. So basically relationship is reverse, in sign reverse. If the profit is plus, tax minus. If there is a negative profit or loss, the sign will be plus for tax. It happened here, you can check. So incremental earning is equal to 1920 from 1 to 4 years. 5th year it is 900,000. Now what we will do? We will do the first adjustment for free cash flow. What is that? That is add back of depreciation. We added back 1.5 million depreciation. What is the second adjustment for free cash flow? Deduct the initial investment, because you have shown the depreciation 1500 multiplied by 5 is equal to 7.5 million. If you have added there, definitely there will be a deduction of the same amount, that is purchase of equipment 7.5 million. So capital expenditure is to be shown in the year 0. These are the two very important adjustments to get the free cash flow. One more is there, that is called working capital change. We will discuss in the next slide. So after getting incremental earning, dear students, the next adjustment is add back depreciation. Second adjustment is purchase of equipment. Third adjustment will be working capital change. Some important adjustments are being done. So if working capital information is not provided, so up to now incremental free cash flow will be In the year 0, minus 7.5 million, purchase of equipment. Year 1 to year 4, 3.42 million. And in year 5, it will be 600,000 positive incremental free cash flow. So after that, one more adjustment is remaining, that is called working capital changes. Let us see, net working capital is equal to current asset minus current liability. Current asset is equal to cash, inventory and receivable. Current liability is payable. Always we have seen in the chapter 2 that when we are doing a cash flow statement, the working capital and current assets in the working capital and cash opposite relationship. Current liability and cash same relationship. So if net working capital is positive means as current assets are more than current liability, that's why it is positive net working capital. If current assets are becoming more, that means cash will be less. So working capital increase means cash will decrease. Working capital decrease means cash will increase. Opposite relationship, working capital and cash. How? Let us see here with an example. Say for example, the incremental working capital will be 20,000. Year 0, year 1, year 2 and year 3 is equal to 0, because year 3 is the project closure. If project is closed, the working capital released. So there is no need of working capital because project is no more, so no more requirement of working capital. So requirement is 0. Now we will see the change in incremental net working capital. How we will do that? Current year working capital minus previous year working capital. In the very first year or year 0 here, it will be 20,000. Why? 20,000 right now. Previous year there was no working capital requirement because the project has not been started. So in the year 0, 20 minus 0 is equal to 20. Year 1, 20 minus 20 is equal to 0. Year 2, 20 minus 20 is equal to 0. Year 3, 0 minus 20 is equal to minus 20. This is the change in the working capital. Now what we will do? We will see the impact on the cash, opposite. If change is plus, impact is minus. If change is minus, impact is plus. You can see here in the line 4, change in the cash flow because of this change in the net working capital is year 0 minus 20,000 and year 3 plus 20,000. Sign is opposite because the relationship of cash and net working capital is opposite in nature. Now let us take the same HomeNet example. Say for example, HomeNet needs 15% of the sales as receivables, 15% of the cost of goods sold as payables. There is no more other working capital requirement is there. Then what will happen? The products are directly shipped from the manufacturer to the customer. There is no inventory required, no cash required, no other thing extra required. No incremental cash or inventory required. Only receivable and payable required. Receivable how much? 15% of 13 million is equal to 1.95 million. Payable how much? 15% of cost of goods sold, that is 5.5 million is equal to 825,000. What is the working capital then? 1.95 million is the receivable, 600,000 is the 825,000 is the payable. So 1950 minus 825 is equal to working capital required 1125. Year 0 no requirement, year 1 onward, because year 0 there is no sale, no purchase. So 0 0, 15% of 0 is equal to 0, 15% of 0 cost of goods sold is equal to also 0. But from year 1, 15% of sales will be 1950. 15% of cost of goods sold will be 825. So the working capital, net working capital will be 1125 year 1, year 2, year 3, year 4. Year 5 there is no project, so the working capital will be released. No need of working capital, so 0 0. There is no sales, no purchase. Therefore 0 0. Clear? Net working capital is clear now. For HomeNet, the net working capital requirement is 1125 from year 1 to year 4. Now what we will do? we will check the increase in net working capital. How we will do that? Increase in net working capital is equal to current net working capital minus previous year net working capital. For example, year 1, increase in net working capital or change in net working capital is equal to year 1 minus year 0 is equal to 1125. In year 2, increase in or change in net working capital is equal to 1125 minus 1125 is equal to 0. Year 3 also same, 1125 minus 1125 0. Year 4 also the same. But in year 5, zero net working capital minus 1125 net working capital. Year 5 minus year 4 is equal to minus 1125. Now impact on cash, opposite. Cash flow effect is if impact or change in net working capital is positive, cash will be negative. So in year 1, change in net working capital is positive, that means cash will be negative. In year 5, change in net working capital is negative, so cash will be positive. Let us do it. The last part of the free cash flow calculation. Up to line 11 we have done. Incremental earning 1920, line number 9, 1920, 1920, 1920, 1920 and minus 900. Add back depreciation, line 10, 1500 each year from year 1 to year 5. Purchase of equipment 7.5 million in the year 0. Up to this we have done. Now what we will do? We will give the working capital change. Impact of working capital change. We have seen impact of working capital change. In year 1, it will be minus 1125. 2, 3 and 4, it will be 0. Year 5, it is plus 1125. Put it here. So, subtract the change in net working capital, minus 1125, and year 5, it is plus 1125. Therefore, incremental free cash flow will be, finally we got the incremental free cash flow. How? 7500, 2295, 3420, 3420, 3420 and 1725. Let us calculate the, let's go for the, this is the given information. Units sold 50,000, expected selling price 260, expected cost price 110, new equipment to be purchased minus 7.5 million, rental, other selling general administrative expenses 2.8 million, marginal tax rate minus 40%, depreciation is equal to the equipment purchased divided by number of years is equal to number of years is 5 years, so it will be equal to 1.5 million. Cost of capital 12%, life of the equipment is 5 years. Okay, now here are the year 0 to year 5 given the data. The revenue is equal to number of units sold multiplied by selling price 1.3 million and the 13 million, sorry, and cost of goods sold is cost per unit 110 multiplied by number of units sold 50,000, 5.5 million, gross profit, then selling general administrative, then depreciation, EBIT. Now from the EBIT we will deduct the tax at the rate of 40%. We will get the incremental earning. Once you get the incremental earning, you add back the depreciation. So we have added back the depreciation 1.5 million from year 1 to year 5. Now what will happen? Next adjustment will be purchase of equipment in year 0. That is 7.5 million. No other purchase in no more years. So it's only shown in the year 0, 7.5 million. Subtract in the increase in net working capital. How we will calculate that? Here is what net working forecast is given. Cash requirement year 0 to year 5, 0, 0, 0 given in the question. Inventory 0 from year 0 to year 5, inventory requirement is 0. Receivable is 15% of sales. So 15% of original sales. Sales of year 0 is 0. 0 multiplied 15% is equal to 0. From year 1 to year 4, 15% of the sales is 1.95 million. And Payable is 15% of cost of goods sold. Year 0, cost of goods sold 0, therefore the payable is 0. From year 1 to year 4, the payables will be 825,000. Again in year 5, there is no sales, no purchase. Net working capital is the sum total of current asset minus current liability is equal to 1.125 million from year 1 to year 4. Year 5 also 0. Now we will see the increase in the net working capital. How we calculate the increase in net working capital? Current net working capital minus previous year net working capital. We can do here current net working capital is 0 minus previous year previous there was nothing because the project started in this year, so it will be 0. In year 1, current net working capital is 1.125 million, previous year 0, therefore increase in 1.125 million. In year 2, 3 and 4, it will be 0 because there is no change in net working capital, same. In year 5, the working capital is not required, we have calculated here. So 0 net working capital. Minus previous year is 1.125 million. Therefore, the change in net working capital is minus 1.125 million. Now impact of cash is reverse of the net working capital. If it is plus, here it is minus, and last year it is minus, so it is plus. This way we have calculated this amount of change is being incorporated in the subtract the net increase in net working capital, impact of cash here. See, increase in incremental free cash flow is in the year 1 there is a increase in net working capital, so here it is decrease in net working capital. In the last year it is decrease in net working capital, so it is plus here. There minus, it is plus here. Now what we will do? We will calculate the incremental free cash flow. In the year 0 it is minus 7.5 million. In the year 1 22.95 million and 2.295 million, and in the year 2 it will be 3.42 million, 3.42, 3.42, and in the 5th year it is 1.725 million. Now what we will do? Cost of capital is 12%. Let us calculate the NPV. NPV is equal to, NPV is equal to first you give the rate of return. Rate of return is 12%. Then the cash flow projected from year 1 to the throughout the life of the project. Year 1 is hit this 2, 3, 4, 5. Bracket close plus initial cash outflow. Initial cash outflow is 7.5 million. 28,62,081. So 2.862 million will be the NPV. Now what we will do? Present value of cash inflows is equal to the NPV minus the initial investment. If you don't take, then you will get the present value of cash inflows. And what does it mean? Positive NPV of 2.862 million means if the company takes this project, it will be equal to 2.862 million extra cash in the bank today, because we have taken everything in today's value at the 12% cost of capital, and it is coming 2.862 million. So the company should accept the project. Now if you can calculate the IRR also. IRR is equal to, so from cash flow range from year 1 to year 5, year 0 to year 5. In cash flow, there is no need of making inflow, outflow, initial cash outflow, no need to do anything. Simply the cash flow stream you can show here from the beginning to the end, enter. It will give if you are accepting this project is giving you 26.56% return. Your cost of capital is only 12%. So accept the project. You can add an if statement here. If the project is, for example, I will make the cost of capital 30%, for example. Make the cost of capital 30%. You see here, your NPV become negative, so reject. And your present value is giving a loss. And your IRR is 26.56%, which is less than the required rate of return, that is 30%. Therefore, you should reject the project. But if the required rate of return is 12%, definitely you should accept the project. It's profitable one. So this is the way we calculate the NPV. Now we will go for some higher order kind of thing, the like simulation, the sensitivity scenario and all. Before that, let me complete this, then we will go for the free cash flow is calculated here. Free cash flow is equal to revenue minus cost minus depreciation, 1 minus tax rate, plus depreciation minus capital expenditure minus change in net working capital. We have done this. We have calculated the incremental earning by doing revenue minus cost minus depreciation, 1 minus tax. We got the incremental earning. We added the depreciation. We added back the depreciation, line 10. We deducted the initial investment, line 11. We adjusted the change in net working capital, line 13. You see here now, plus depreciation minus capital expenditure minus change in net working capital. Open the brackets, it will be equation number 9.7. So calculating the free cash flow directly, you can calculate the depreciation tax shield by tax rate multiplied by depreciation. We have done one right treatment, wrong treatment. There we have calculated how depreciation tax shield is calculated. Directly in a question, it might be asked you, calculate the depreciation tax shield. How you will do it? Tax rate multiplied by depreciation is equal to depreciation tax shield. For example, Cisco manager believes that the HomeNet project has a risk similar to his existing projects for which it has cost of capital 12%. Compute the NPV of HomeNet project. We have calculated NPV also, we have calculated IRR also, and become a profitable one. Taking 12%, we have calculated the NPV. NPV is 2.862 million. IRR is coming 26.67. So the company should accept the project. Why? If HomeNet consider this project, it will be giving extra 2.86 million in the bank today. So this project is that profitable, so it should accept. So I will stop here the recording for just a minute for your questions.